Hello everyone and welcome back to the sessions on economics for finance. Here we are continuing with the chapter public finance and this is the fourth lecture on public finance. In this class we are going to deal with the fourth unit and that is fiscal policy. So you may please write up heading as unit 4 fiscal policy in your notebooks. So the obvious question that would arise in your mind first of all is what exactly is the meaning of fiscal policy? So let us discuss that same thing. Fiscal policy involves the use of government spending, taxation and borrowing to influence both the pattern of economic activity and level of growth of aggregate demand, output and employment. In other words, fiscal policy is designed to influence the pattern and level of economic activity in a country. Fiscal policy is in the nature of demand side policy. Government of all countries pursue innumerable policies to accomplish their economic goals such as rapid economic growth, equitable distribution of wealth and income, reduction of poverty, price stability, exchange rate stability, full employment, balanced regional development, etc. So please write up this whole content and then I take you ahead. Alright friends, let us move ahead and now understand the objectives of fiscal policy. Achievement and maintenance of full employment, maintenance of price stability, acceleration of rate of economic development, and equitable distribution of income and wealth. You could actually make out that these 4 points what we have written over here were the contents of the last paragraph of the previous slide that I have shown. But yes, these are 4 very important points. Why do we need government to formulate its policy? What are its core objectives? The core objectives have been stated over here. Priorities of these objectives may vary from country to country. Stability and equality may be the priorities of developed countries, while economic growth and equity may get higher priorities in developing countries, of course countries like India. So please write up this whole thing and then I take you ahead. Alright friends, let us move ahead and continue writing further under the heading non-discretionary fiscal policy, that is automatic stabilizers. Fiscal policies which operate automatically are non-discretionary policies. So basically discretionary means something that government is doing willingly by taking steps, and certain policies which are on an auto mode will be considered as non-discretionary policies. These are built-in policies and part of the structure of the economy. It automatically reduces the expansions and contractions of the business cycle without any government intervention. So please write up this much and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further. Taxation policy and government expenditure works automatically. Instability caused by business cycle automatically dampened without any need for discretionary policy action. It automatically increases aggregate demand when recession is there and reduces aggregate demand when there is inflation in the economy. Personal income taxes, corporate income taxes and transfer payments, unemployment compensation, welfare benefits could be example of transfer payments, are prominent automatic stabilizers. So please write up this whole thing about non-discretionary policies or automatic stabilizers, and then we shall move ahead. Alright friends, let us move ahead and continue writing further under this heading, that is instruments or tools of fiscal policies. Tools of fiscal policy are of four types. Number 1, government expenditure. Number 2, tax. Number 3, public debt. And number 4, government budget. So we are going to have detailed notes writing on all of these four aspects. Once you cover up these four aspects, the chapter completes. That means this particular unit definitely completes. So we are going to have detailed discussion on each of these four, but first quickly write up these four headings right now. Alright friends, let us move ahead and get started with the first component, that is government expenditure. Government expenditure are of three types. One is the current expenditure to meet the day-to-day running of the government. Second is the capital expenditure, which are in the form of investments made by government in capital equipments and infrastructure. And the third one is what we call as transfer payments. So these are basically welfare kind of expenditures incurred by government, and these three would form typically what we call as government expenditure. So before I take you further in depth of these, please write up this much quickly. Alright friends, once you have finished writing this whole thing, let us move ahead and continue writing further, and let us observe what will happen in case of recession. During recession, high government expenditure, this will increase employment, and this increase can be directly as well as indirectly. So basically, whenever there is a recession, government will increase its expenditure, which will generate more employment directly as well as indirectly. Now what we mean by directly, when government appoints the recruits directly for its own project, that is what we call as a directly generation of employment by government itself. And indirectly means when government is assigning projects of its expenditures to other parties. For carrying out those projects, the other parties who are suppliers of services will have a need to make more and more employment, which we call as indirect employment in this case. So when government increases its expenditure, it will cause increase in employment directly as well as indirectly. This will increase the income in the hands of general public. This increased income will lead to increased demand for goods and services, and this will cause industries to produce more output with respect to goods and services, and this will lead to industrial growth. So can you notice one thing? During recession, just because of government expenditure, there can be again a start of industrial growth, exactly following the chain that I have shown you over here. And reverse will be the case when it is a case of inflation. So in case of inflation, government will lower down its expenditure, which will decrease employment directly and indirectly, and this will decrease income in the hands of the public. And then what will happen? If the income is decreased, people will tend to spend less. That means the demand also decreases, and decrease in demand will result into decrease in price level, through which inflation can be controlled. So this is something very, very important. As I have explained, just write it down and then we shall move ahead. Alright friends, once you have finished writing this whole thing, let us move ahead and continue writing further. Taxes, which is the next factor. In case of recession, what can be done with taxes? Just use your simple common sense that when there is a recessionary phase, what is happening? People have lesser money in their hands, right? So what government would basically do is they would reduce the rates of tax and would give some exemptions in taxations, and therefore this will result into low tax. Low tax will result into high business and personal disposal income. So what will happen? Suppose earlier the tax rate was 30%, so out of 100 rupees of income, an individual was having only rupees 70 after tax at his or her disposal. If this rate of tax could be reduced to 15% or 10%, the disposal income in the hands of individuals will automatically rise. And with this increased level of disposal income, what will happen? There will be increase in demand, and increase in demand will result into increased output by industries, and this will finally result into industrial growth due to high demand. On the other side, when the tax rates are lowered down, not only for the individuals, even for industries, it will be an incentive to produce and sell more to earn more profits, and finally it would automatically counter the recessionary situation in the country. And exactly opposite thing should happen when it is a case of inflation. During inflation, the government will simply increase the rates of tax, so high tax and new taxation will be imposed, which will result into decrease in the purchasing power. Indirectly we can say reduction in the personal disposal income, and this will result into decrease in demand, and this will eventually result into decrease in price level, which will be an counteraction over inflation. However, excessive taxation usually decrease new investments, and therefore the government has to be cautious about a policy of tax increase. So government has to play very smart when and by how much the tax rates should change, and that is why this is one of the very important fiscal policy tool. So please write up this whole thing and then I take you ahead. Alright friends, I am sure you have finished writing this much. Let us move ahead and now talk about the next component, that is public debt, internal and external. First of all, what is the meaning of public debt? When government of a country borrows money from the public, it is generally called as public debt. Now what is internal public debt? Internal public debt is when the borrowings are raised by government locally within the country. On the other side, when the government of any country is raising borrowings from external sources, that is from other than domestic sources, that could be external public debt. So let us write a note on that. When the government borrows from its own people in the country, it is called internal debt. When the government borrows from outside sources, the debt is called external debt. Now there could be even market loan and small savings. In the case of market loan, the government issues treasury bills and government securities of varying denominations and duration which are traded in debt markets. The small savings represent public borrowings which are not negotiable and are not bought and sold in the debt market. So please write up these two paragraphs and then I take you ahead. Alright friends, after writing these paragraphs, let us now observe what government can do with respect to public debt under recessionary situations and under inflationary situation, and how fiscal policy will influence the economy over here. So let us try to observe first of all in the case of recession. First of all, government will try to start making repayments of its loan. That means when there is a recession in the market, government has borrowed money from the public, government will start repaying this amount to public back. This will eventually increase the supply of money in the hands of the public. That is, supply of money increase in the market, and therefore this will cause an increase in demand, and increase in demand will finally lead to increase in production, and this will finally result into industrial growth, that is increased industrial growth. And opposite will happen when it is case of inflation. During inflation, when the government has to establish certain controls through its debt, government will start borrowing more money. When government is raising more of public debt or borrowing more money from the public, what will eventually happen? The supply of money in the market will decrease. This will result into decrease in demand because people have lesser money now in their hands to spend, and government can play fantastic over here by issuing government bonds or government securities with attractive interest rates. So public in general will be finding this as a great opportunity, and generally these kind of government securities, the interest income what is earned from these government securities, that interest is also exempted from tax. So whenever government is coming up with an issue of new bonds or new securities, public will always be inclined to subscribe for such bonds and securities, which will finally result into reduction in the supply of money in their hands, and this happens to decrease the demand in general, and the price level will also tend to decrease, which will again have a counter effect on the inflation. So please write up this quickly and then I take you ahead. Alright friends, once you have finished writing this much, let us move to the last tool, that is government budgets. So when we talk about government budget, budget is simply a statement of revenues earned from taxes and other sources and expenditure made by a nation's government in a year. Now the types of budget could be three types, that is balanced budget, deficit budget and surplus budget. Let us first understand what is a balanced budget. When expenditures in a year equal its revenue for that year, it is called balanced budget. It will have no impact on the demand because expenditure and revenue being matching, it's wholly balanced out, and therefore this will have no impact on the demand. Therefore no changes in the price level will occur. On the other side, what would happen if there is a surplus budget? First of all, surplus budget would indicate that revenue of the government is more than its expenditure. When this happens, what will be the impact? When the government collects more than what it spends, it reduces demand and control inflation. It decreases nation's debt but it reduces industrial growth. So one drawback of surplus budget could be it will cause a reduction in the industrial growth. Before I give you note on deficit budget, please write this much first of all. Alright friends, so once you have finished writing this much, let us move ahead and write about deficit budget. When the government expenditure in a year is greater than the tax revenue it collects, it increases demand, output, employment and industrial growth, but it increases nation's debt. Now, we would always observe one thing, that whenever government is coming up with some kind of fiscal policy, during the recessionary phase it will have a different kind of implementation, and during the inflationary phase it will have a different kind of implementation. As a result, we may classify the fiscal policy into typically two types, and these two will be expansionary and contractionary. So expansionary means the policy is intending to expand the economic growth. Contractionary means the policy is meant to reduce or contract the operations and the economic growth. So of course, under recessionary phase, the government would want to have expansionary fiscal policy, and during inflationary situations it would want to have contractionary fiscal policies. So first write this much and then I give you details of these components. Alright friends, so let us move ahead and continue writing further. Expansionary fiscal policy. It is designed to stimulate the economy during the recession phase of a business cycle. This is accomplished by increasing aggregate expenditures and aggregate demand through an increase in all types of government spending and or decrease in taxes. Contractionary fiscal policy. It is designed to restrain economic activity during inflation phase. This is carried out by decreasing the aggregate expenditures and aggregate demand through a decrease in all types of government spending and or an increase in taxes. So please write up this whole thing, and that would be end of this part.